Hello and welcome to the latest in our Insider interview video series. Today I'm joined by Mohneet, Dhir, who is a product specialist on the Vanguard LifeStrategy funds range. Mohneet, thanks for joining me today.
Thank you, it's lovely to be here.
So the Vanguard LifeStrategy range launched over a decade ago, and each of those 5 funds in the range, they have outperformed comparable funds in the investment association sector. Does this show that index investing is the best route to success for investors that are after diversification?
We are incredibly proud that the Vanguard LifeStrategy range has been able to serve investors well over the last 10 years. And we think a big part of that has been the simplicity of the funds and the transparency that they offer in terms of the asset allocation and the underlying building blocks that the funds invest in. As you can see that the funds are incredibly diverse, so you're not putting all your eggs in one basket, which is going to be more and more important going forward as we enter a market which is going to be extremely uncertain with, recovering post-COVID, high inflation, highest inflation we've seen for a while, extremely low yields on bonds. So it's going to be even more important to be incredibly diversified. And while LifeStrategy funds have been great performers beating index and active funds within their Morningstar peer group, we do still think that there is a place for active funds. It really comes down to what the goals of the investor are. So, for example, if an investor, depending on their risk appetite, they could choose either an active fund or an index fund, depending on what their time horizon is, depending on what they're investing for. There are many factors that they need to consider essentially where to invest. We're also one of the largest active fund managers in the world. And people often forget that. So we're not against active investing. We think there's definitely a place for it, but we think it's important for investors to know what they're investing in, whether that's index or active, and for there to be transparency in what they're investing in and really understand what it is that's underneath the bonnet of their investments. And it really comes down to the 4 key investment principles that Vanguard LifeStrategy funds were based on when they were launched. And that's starting with a clear goal for your investments. Why are you investing in the first place and what are you looking to achieve from it? Making sure that there's a balance within your investments, whether that's through equities and bonds or just making sure that you have enough diversification, but then also just being really mindful about cost because it eats into your returns. And I think for all of these reasons, the funds have performed well over the 10 years and have been a great investment for many.
And is that place for active funds then potentially as a satellite holding rather than as a core holding?
It could be either, to be honest. It depends. Again, it depends on the goal of the investor. And some of our investors actually use the LifeStrategy funds, for example, as a core holding, and then they'll complement it with another active proposition or an active product, and such as our global credit fund, for example. And I think it's important, again, it comes down to those 4 key investment principles. If your investment goals demand that you use LifeStrategy as a core holding and potentially have an active fund, which gives you a bit more risk that you want because it's in line with your investment goals, that's something investors do as well. So it doesn't have to be one way or the other. You can definitely mix them with active funds.
So in the years to come, do you expect the fund range to be as successful as it has been over the past decade, particularly when in the decade to come, the expectation is that returns are likely to be lower than investors have been used to?
Yes, so we're going into an extremely difficult time for markets, for investors, for everyone really, whether that's investing or personal life, given where inflation is. We really hope that the LifeStrategy funds can provide investors with the same sort of sustainability and returns that we've provided over the last 10 years. In fact, we're positive that they will, given that the asset allocation is strategic, so we don't make market calls. We're not trying to time the market, which is becoming more and more difficult to do given how much uncertainty and moving factors there are. And central banks are becoming more unpredictable as well in the way that they do things. So we're hoping that the strategic asset allocation will play its part over the future as well as it has done over the last 10 years. Being strategic allows you to really hold your positions and ride through market turbulence and market storms, especially if you have the right balance in your portfolio. So if we take, for example, the 60-40, the 60% equity fund, it's almost a perfect balance where you've got 60% equity, but you've got 40% bond exposure, which acts as a buffer when there's equity volatility. So that's the kind of mix and things that you need to think about when you're investing for the next 10 years, because the returns are going to be lower. That's just a reality. You know, we've been living amongst central banks providing a lot of stimulus into the market, and that's changing, and we just need to come to terms with reality that return expectations for the next 10 years are lower than last 10 years, but that's okay.
So what do you make of, there's been a number of commentators and plenty of articles written saying that the 60-40, 60% in shares, 40% in bonds portfolio model is outdated and will become particularly challenged in an environment of higher inflation. What's your thoughts on that, particularly given the Vanguard LifeStrategy 60% equity fund invests in that manner?
So the LifeStrategy 60% equity fund is actually one of the largest within the range, and we feel proud that investors have faith in us through that product. We think that going forward, the role of bonds and that 60-40 mix, the equity bond mix is going to be even more important than it has been in recent history, whether that's the last 10 years or the last 30 years. And the reason for that is the next 10, 20 years are going to be different from what we've seen in the last 10 to 20 years. Especially in the next 10 years, we're likely to see more uncertainty. Since the global financial recession, we've had record amount of stimulus from central banks, and that's changing now. And what that means is more uncertainty in the market, but also we're recovering post-COVID as a world globally. We've also got highest geopolitical tensions that we've had in a long time. So all of these factors combined actually indicate the need for bonds being even higher going forward than they have been in the past. And especially in a multi-asset portfolio, the role of bonds is extremely important going forward, because we always ask investors to think about bonds as the defensive element in their multi-asset portfolios, because their role is to make sure that they can buffer off the volatility that equities bring into a multi-asset portfolios. Equities are extremely important as return generators, but you also need bonds to be able to make sure that the volatility doesn't impact your overall return. And additionally, it's extremely important for that bond allocation in a 60-40 portfolio to be diversified, not just across the maturity spectrum, but also across the credit spectrum. So not to be only invested in triple A's or double A's, but to also have triple B's. It just provides investors a varied source of return rather than putting all your eggs in one basket when you're thinking about fixed income.
And as well as having high inflation levels to contend with, investors are also having to think about interest rates, which are on the rise. So how concerned at all are you regarding interest rates in relation to bond duration?
So duration essentially is a measure of interest rate risk that comes with a particular bond. And you're correct that interest rates are going to be higher going forward, as we've heard from central banks and the guidance that they've given. That doesn't mean that they should be concerned about investing in bonds. Are the returns going to be different from what we've seen in the last 10 years? Yes, because yields are going to be higher. That's just the nature of the market as it is right now. However, when investors are thinking about duration risk or bond risk in general, investing in bonds, it's important to always come back to the point of diversification. So often in an environment where central banks are raising rates, investors tend to sort of flock towards shorter duration bonds, which essentially means investing in shorter maturity bonds. Now, that's essentially putting all your eggs in one basket. You're exposing yourself to a market event, to a market risk, and to essentially higher risk than you probably signed up for. And when I talk about diversification, that can be across different maturities. So in LifeStrategy funds, for example, we invest in bonds from maturity of 2 years up to maturity of 30 years. And that just goes, and there's, various maturities along the way. And what that really does is spreads your risk out across different maturities across the yield curve. Now, if we think about the yield curve, which is essentially bonds of different maturities, going all the way up to longest maturity and how much they provide in terms of yield. So as investors go into longer maturity bonds, you should get compensated for higher yield because you're taking more risk over a longer period of time. Now, what's interesting when you think about the yield curve is that different bonds perform differently in different environments. So if you look at the yield curve, it doesn't always react the same way in different market events or market turbulence. And it's worth keeping that in mind, because when you enter markets which are uncertain, where you're not 100% sure as to what is going to be the result of central banks increasing rates, how is it going to impact bond markets, and when you have moving factors such as inflation, we essentially have, potential, the most highest geopolitical risk we've had for a long time. The environment that we're going into going forward is very different from what we've seen in the last even 30 years, I would say. So it's important for investors to keep all of that in mind when they're thinking about duration risk. It's not just about how high is my duration. In fact, if you look at global bonds, so the global bond index has a duration of over 9 years, but in the first quarter of this year, which was extremely disruptive and volatile for investors due to Russia's invasion of Ukraine, it's so interesting to see that global bonds were actually one of the best performers in terms of risk-adjusted returns. So what that means, the returns that they provided, adjusted for the volatility that they introduced in the portfolio, was actually one of the highest amongst equities, different bonds, amongst commodities and gold as well. So that's something for investors to consider. Bonds often get a bad name, but they are actually one of the best risk-adjusted investments an investor can have.
And has Vanguard considered, or is considering now, adding alternative assets such as property and infrastructure in order to give some additional diversification as well as having equities and bonds?
So when we introduced the LifeStrategy fund, and the research we did prior to that showed that the equity bond mix actually works really well over different market cycles without the need to add alternatives such as property, commodities, etc. We are continuously looking at this, and our research team, the investment strategy group that works within Vanguard, who's responsible for looking at different market dynamics, behaviors, correlations, etc. Our research doesn't show at this point in time that we need to add anything else into LifeStrategy. We still think that the equity bond mix works. But as I said, we continuously review it. So if that changes at some point in the future, if correlations change quite dramatically within the market, the dynamics of different asset classes change, then it could be something that we do further research into.
And our final question, which we ask everyone that we interview, do you personally invest in any of the 5 funds in the range?
I do indeed, actually. So I myself invest in the LifeStrategy 80% equity fund. I'm actually investing mostly to help my son and to hopefully renovate our house sometime in the future. So I feel that 80% is a good mix for me, given my time horizon, and the 20% bond allocation helps buffer any equity volatility. However, my son, who is 2 years old, I recently opened a junior ISA for him, and he is invested in LifeStrategy 100% equity because he's got a long time to go before he's going to need that money.
Mohneet, thank you for your time today.
Happy to be here. Thank you for inviting me.
That's all we have time for today. You can check out the rest of our Insider interview video series on our YouTube channel, where you can like and subscribe. Look forward to seeing you next time.